inventory, and we're going to cover quite a few topics in this lecture, so we'll begin. The objectives of this lecture are to describe the importance of control over inventory, and if you recall from your merchandising lecture, that's where we first touched on inventory and that merchandisers use inventory, and now you need to know how to account for it. The second objective is to describe the three inventory cost flow assumptions and how they impact the income statement and balance sheet. We're going to talk about three different ways to do inventory costing. And we're going to determine the cost of inventory under those methods using the perpetual system. And those methods are FIFO, LIFO, and the average cost methods. Then we're going to talk about determining the cost of inventory under the periodic system. So we're going to do perpetual and periodic and what the difference between those are. Compare and contrast the use of the three inventory and costing methods, and describe the reporting of merchandise inventory on the financial statements. The first objective is to describe the importance of control over inventory. There's two primary objectives of control, and as we're going to learn from here on out through the rest of the semester, controls are really important in accounting, and a lot of laws and rules have changed over the last several years because of fraud in business and whatnot. So those two primary objectives are safeguarding the inventory and properly reporting it on the financial statements. So as I'm talking in your mind, you have to think about inventory. It's stuff on a shelf. It could be expensive stuff. It could be little things, depending on the industry that you're in. If you're in a software technological type of industry, it might be little tiny chips or wires, or it could be big servers. It could be computers. In the healthcare industry, it could be anything from a bandage all the way up to expensive things that we implant into patients, and any gamut of things. So just keep in mind that we talk about it as a unit or an item, but it could be any type of inventory. Controls over inventory include developing and using security measures to prevent damage to the customer or the employee related to theft. So we're looking at controls that will keep people from stealing and damaging. To ensure the accuracy of the amount of, inventory reported in the financial statements, a merchandising business should take a physical inventory. And what that means is that once a year, you're going to count your inventory, and some businesses will do it even more than once a year. Maybe they do it quarterly. The second objective is to describe the three inventory cost flow assumptions and how they impact the income statement and the balance sheet. And we're going to spend a lot of time on this. And it's covered really well in your book, but hopefully the examples I've made up will help you too. There are costing methods, and we're going to talk about all three of them. And what this means is it's how the inventory flows in and out, and how you do it on your books is not necessarily how you're really actually selling the goods. So under FIFO, which is the first in, first out method, the first purchased goods are the first sold goods. So here you see the goods going in and the goods going out. So the first goods purchased are assumed to be the first goods sold. In reality, that might not be what's happening. In LIFO, the last goods purchased are the last goods sold. Okay, so last in, first out. And then the average cost is a weighted average or a blend of the goods going in and out. Here's just another picture to hopefully help you see it, and we're going to talk about this more. Remember that sales less cost of merchandise sold or cost of goods sold is gross profit. So under the FIFO method, if you have the first in, first out, the first goods sold will be the first goods purchased will be the first goods sold. So that's going to be the first purchase here, which is May 10th. So you can see that. Under LIFO, last in, first out, it would be the May 24th stuff coming out first. Okay, so in your mind start thinking this changes my gross profit because goods change price over time. And then the average cost is an average of the three different prices divided by the units to get an average cost. And if you notice, the average cost is always between the FIFO and the LIFO. It always happens that way. So this is a good slide. This is a good PowerPoint to probably print out and study. I tried to make you a lot of slides in this one. Here's a comparison. We're going to talk about this a couple of times. Given beginning inventory is the same under all methods, and purchases are the same under all methods, your goods available for sale. Remember, your goods available for sale is the total population that you could sell if you had the people to buy it. Then your ending inventory gets costed under these different methods, so that changes your cost of goods sold. So what fluctuates in your inventory costing situations is the ending inventory is valued differently and the cost of goods sold therefore change. So here's, you can see that the weighted average falls between the LIFO and the FIFO. That's the way it works. It's a kind of gut check. Okay, so let's do like an example. Here you have 3 identical inventory items were purchased during July. So you have purchase 1, 2, and 3. And the cost was different. Assume that 1 unit is sold for $150. Determine the gross profit under the 3 methods. Okay, so under the FIFO, first in, first out, you have your gross profit at the first item. So there's the first one. And your ending inventory is the old stuff down here. Under LIFO, last in, first out, the last one is sold and the old stuff is left in inventory. Okay, so there was the last one purchased. It's the first one out, so you have these 2 left. And under average cost, you have a blend. So this is just a simple example for you to kind of get your idea of what we're talking about. And we're going to delve into this a little deeper here. The third objective is to determine the cost of inventory under a perpetual inventory system. Okay, so the difference between the perpetual and the periodic inventory system, we touched on it in the merchandising chapter, is that perpetual, every time an inventory transaction happens, the accounting records are affected. Typically you use an accounting system, a computerized system, because this would be very manually intensive. Under the periodic, you just take a physical once a year and you flush out your cost by counting your ending inventory and valuing it at the cost at that point. So this section is on the perpetual inventory. In FIFO, the cost and ending inventory are the newer cost, and the cost of merchandise sold has the older cost. First in, first out. FIFO, another way to look at it, is the cost of inventory from the bottom up. Newest is sitting in the inventory. So just kind of a couple of ways for you to think about this. Under the FIFO perpetual inventory system, you're going to have your cost of merchandise sold on these dates. And I'm trying to show you here that if you had a beginning inventory, and then you had a sale, and then you had a purchase, and then you had a sale, you would at the end have sold 35 units. Okay? So you have to figure out where they come from. So under FIFO, it's first in, first out. So you're going to sell the first 28 out of this bucket, and I talk about inventory as buckets. Then the next 7 are going to come out of this bucket because this bucket's empty. Okay, so I did this little example here so you could see kind of how it flows. So there's another way to look at it. So you had beginning inventory, you sold 35, you have 22 that you purchased, you have 15 left. So you have 15 units at $38 because this bucket is empty and you only have this bucket left. So that's $570. Here's another way to look at it. So I'm showing you 3 different ways to look at it. You have your original inventory, beginning inventory, costed out. Then you had a sale, so you had 28 at $34, you sold 15 at $34, so you're down to 13 at $34. So right now, here's your cost of inventory. This is a perpetual system. Then you purchased 22 at 38, so now you have 13 at 34 and 22 at 38. Then you sold another 20 here. So you take it first in, first out. You got to take the 13 of the 34 and then the 7 of the 38, and that leaves you 15 of the 38. So there's my 570. So this is just a more detailed way to look at it, and here's my cost of goods sold, which is the sum of these. Okay, we're going to go through the same thing. This is an example that's in your book that shows you the same thing. It's just another slide for you to look at. Okay, in LIFO, the cost in ending inventory are the older cost, and the cost of merchandise sold has the newer cost, last in, first out. Okay, so let's try that example. Same scenario, you had sold 35. So here you had these 20 are coming out of the last purchases because it's last in, first out. So 20 came out of here, so you have 2 left. This sale here came out of here because you're on a perpetual system. So the perpetual makes a difference in how the flow works as you move down. So when you look at this example, once again, here's my beginning inventory at the $34. Then I sold 15 out of, that's the only bucket available because we're doing a perpetual system. So there's my 13 left at this. Then I purchased 22 at 38, so up to here we look about the same. It's this last sale that you have to think about because it's last in, first out. So you're selling 20 of this bucket right here, last in, first out. So you have 13 left in this bucket and 2 in this bucket. So notice my inventory cost is valued lower than under the FIFO method, but my cost of goods sold is higher. So print these slides out and you can set them side by side, and it really will help you see the flow of the inventory. Here's just another picture of another example for you. Okay, this one I'm going to come back to. Okay, the average cost method is used in a perpetual system. If it's used within a perpetual system, the average cost for each type of item is computed each time a purchase is made. We rarely use the average cost method if we're doing it manually, so we're not going to show it right here because most people who want to do this have a computer system. So keep in mind you can do it under a perpetual system, but we're not going to talk about it because it's really manual. Okay, computerized perpetual accounting systems. Most companies will use a computerized system if they're going to do perpetual inventory. And what I found from all the different industries I've worked in, from the time I was in public accounting till now, manufacturers use perpetual inventory accounting systems. A lot of other businesses use a periodic system. And they book everything to expense, and they do an inventory once a year, and they make an adjustment. And even in healthcare, I've worked in 3 major healthcare environments, and only one of them had a perpetual system. And it always amazes me because it really swings your cost if you use a periodic system. So the best is to pick up an accounting system and use a perpetual system. It tracks all relevant information, the item, the description, the quantity, the cost, the size, the location, everything about it. And you can print out tons of reports. For every inventory transaction, there's an entry in the system. They'll use barcode scanners and other technology. So it's a really important thing if you have an accounting system and you're going to go perpetual, that you understand how it works and you build the controls in. And then once again, you still take a physical inventory at the end of the year to make sure that your perpetual system is tracking properly in the accounting system. Okay, our fourth objective is to determine the cost of the inventory under the periodic inventory system using FIFO, LIFO, and average cost. So now we're going to show you the same thing we just did under the periodic system. So this means you don't do anything until the end when you count your inventory, and then you look back and you cost your inventory. So using FIFO means the earliest batch purchased is considered the first batch sold. Okay, so you're taking a snapshot in time at the end. So here's my same example. You're going to assume that you're using FIFO. So you're at the very end of time, and you're going to look at what you're selling, and you sold 35, so you're going to have an ending inventory of 15 units, and it's first in, first out, so you assume that there's 15 units left of the 22 that you got at the end. Okay? Here's a flow. This is a nice graph if you kind of need a visual that shows you how things flow. It's different numbers, but it's kind of an exhibit from your book. Under LIFO, LIFO assumes the most recent batch purchase is considered the first batch of merchandise sold. Last in, first out. So you're talking periodic system. At the very end, you look back and you see what you're doing. Remember what I said earlier, this doesn't mean that this is what you're really doing in real life. They give you this little example. If you're selling fish, you know the first fish you bought is the first fish you're going to sell. But that doesn't mean how you do your business is how you have to cost your inventory. You choose as a business how to cost your inventory. So here's our little example, the same example that we've been using all along. Now you have an ending inventory of 15 units. It's last in, first out. So you're going to go back up to the top. If you only have 15 units, you start costing from the top. So my bucket, I start at my top bucket. And notice that I have 15 at 34. Okay? Here's another little visual for you. You can print out and help you understand. So now we can talk about the weighted average under a periodic system. The weighted average unit is based on identical units. You don't get to blend things. Of all the units you have, you get an average of the available for sale, and you use that cost to apply against your cost of merchandise sold. So here is my same example, okay, that we've been using. Now I say I had 28 units at 34, which is $952, 22 at 38, which is $836. This is my goods available for sale. 1788 divided by, I added those up. Yeah, 50, I'm sorry. Yes, 50, okay? So 1788 divided by 50 is $36. Notice my average is always between my high and my low, and that makes sense. Mathematically, that makes sense. So now my ending inventory is 36 times 15, which is 540. So let's compare and contrast and show them side by side. Okay, so all I've done is show you how to get your ending inventory under the periodic system. You have to back into your cost of goods sold. Here's my comparison of my methods. So now we have to let's assume we sold 35 units and they were $40 a piece. Okay, so my sales are $1,400. So under FIFO, here's my sales. Here's my beginning inventory. If you've printed out the slides, you can backtrack where these numbers came from. I showed you in all the previous slides. Plus my purchases is my goods available for sale. Less my ending inventory under FIFO gives me my cost of merchandise sold with a gross profit of $182. Okay, so let's show it under LIFO. Notice that my top part's always the same under the periodic system because you're looking back and doing this at the end of the period. And there's my ending inventory, and here's my gross profit. And then my average cost comes out in the middle. So print all the slides out, and if you have to, listen to the lecture again and kind of follow me along, because when you look at them side by side, this is what it looks like. Here's my net sales, here's my beginning inventory, and here's my purchases and my goods available for sale. So under the periodic method, up to that point, they all look the same. Then you calculate your ending inventory under the method, and you back into your cost of goods sold. And that is what's fluctuating between the ending inventory and the cost of goods sold, giving you a gross profit. You cannot change your method to get a bigger gross profit on a whim. You pick a method and you stick with it. And if you choose to change your method, you have to report that in your financial statements as a change in accounting method, and that is big. If you're audited and you have an auditing firm, they put that right on the front of your report, and it's a red flag, because as you can see, one year you might want to do FIFO, and then maybe the next year you might change. Because note, with FIFO and rising costs, cost of goods sold is lower and ending inventory is higher. And that's in our situation, our prices were rising. However, under LIFO and rising prices, cost of goods sold is higher and ending inventory is lower. So keep in mind, you can use different methods for tax purposes, and I don't talk about tax much in this class because you have to take a tax class later. So don't get confused. But from an income statement standpoint, a company, if they want to change a method, has to notify their owners and shareholders in their report, because it's a big thing. And average cost always falls between the two. Our sixth objective is to describe and illustrate the reporting of inventory on the financial statements. If the cost of replacing an item in the inventory is lower than the original purchase cost, the lower of cost or market method is used to value the inventory. So market as used in lower of cost or market, is the cost to replace the merchandise on the inventory date. So let's say that you had a bunch of inventory valued at cost, and all of a sudden the economy's changed or your product's changed. It's not obsolete, but it's really taken a dive. You have to note that on your financial statements that your market cost is lower than your cost of books. Now you don't get to report higher. You only are forced to report lower. Cost and replacement costs can be determined for each item in the inventory or major classes or categories of inventory or the inventory as a whole. Okay, so the slide for this I think is up further. So when you print these out, you'll see that slide where I have a little picture of it. Oh, here it is. I must have it in there twice. Sorry. Okay, so by item, you can do lower of cost or market. So you can see the cost is this and the market's this. So the lower of cost or market's actually lower for commodity A, and cost is lower for commodity B, etc. So you can either value it by commodity or you can do it in total. So this is for financial statement purposes, and I'll reiterate it again. This is the check that your inventory is not valued too high in a situation where market is justifying a lower value. Merchandise that is out of date, spoiled, or damaged should be written down to its net realizable value. So when you take advanced accounting, you're going to spend a lot of time on obsolete inventory, but for this course, we just barely touch on the fact that if merchandise is spoiled or damaged or obsolete, then you write it down to the net realizable value. And merchandise inventory is usually presented in the current assets section of the balance sheet following receivables. So it's the third most liquid asset in your balance sheet. Cash, AR are first, because it's hard to just dump your inventory if you have to. And you also note the method of determining the cost of inventory with the balance sheet. So here's a picture. Here, notice here's my merchandise inventory at lower of cost, first in, first out method market. So you tell the reader what you did, how you got it. And then if you have financial statements and you take advanced accounting later, you're going to see that in the notes to the financial statements that you will spell out exactly how you got your number. In summary, I know I probably spoke a little fast. I try to keep these down to a certain amount because they're hard to download if they're too long. We went over inventory and controls, inventory costing methods, the perpetual and the periodic systems, and reporting of inventory. I want to say that there's a lot to inventory. This is fairly mechanical in this class because it's beginning accounting. If you take advanced accounting, as I mentioned, you'll go into more about inventory and the types of controls. The biggest control in inventory is making sure that the inventory can't disappear. And with that, you build controls in place. You build separation of duties between the people receiving the inventory and the people buying and the people selling and things like that. The costing method that you pick is important. You have to stick with it. If you make a change, it is something you have to report on your financials. Companies will choose if they want to use a perpetual or a periodic system, and they'll remain with that. And then, yes, you report your inventory on your balance sheet. And the effect of the cost of goods sold or cost of merchandise sold goes through your income statement, and it does affect your profit or loss. So that's it for the lecture, and I just print these out, and if you have any questions, let me know. Thanks.